Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's program is sponsored by Building Insurance and Risk. Don't put your real estate investment in peril. Work with Building Insurance and Risk and receive multiple coverage offers with a side-by-side coverage comparison. To learn more, go to buildinginsuranceRisk.com. Today, my guest is Jason Stubblefield. Jason has been investing in real estate for over 10 years. He started with single-family homes and has since moved into the multifamily real estate space. He scaled his portfolio to over 100 multifamily units in just a few years. Jason grew up in a lower class family and was always mindful of the tenants he served. That concern led him to the transition company into the affordable housing space. His company is now devoted to helping solve the affordable housing crisis while maintaining strong returns for his company and his investors. Prior to becoming a full-time multifamily entrepreneur, Jason spent over 11 years in the software development and has a Bachelor of Science degree in computer science from the University of Memphis. He is also a United States Marine Corps veteran. And in just a minute, we're going to speak with Jason about multifamily investing and affordable housing. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Jason Stubblefield. Welcome to CRE PN Radio.
Thanks for having me, Darren. I'm glad to be here.
Well, I'm really looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, definitely. You really summed it up pretty good with that introduction. Started off lower income family. Really just started trying to better my life from what my current situation was. So I started out with just joining the Marine Corps right out of high school. Then that led me to once I got out, did 4 years in the Marine Corps. I went and got a degree in computer science, and then from there, I was on my way around the corporate ladder, climbing the corporate ladder. And that's what led me to real estate, because I realized that I didn't want to do it, even though I was quote unquote successful by some people's opinion. That led me into real estate and started a single family, and then saw that was going to take me a lot of time. So then I scaled into multifamily. And the only thing that was a little incorrect with the introduction, it was 1,000 units. We went to a little over 1,000 units in multifamily apartment buildings. I started out with 134 unit, and that sort of led me to where I'm at right now.
Got it. Well, first off, thank you for your service. Appreciate anybody that's willing to put on the uniform and go to defend and be there for our country. Appreciate that. So let's talk about your portfolio. So you said you started off in a single family. How many units did you end up with before you realized that was kind of the slow road?
Yeah, it wasn't a lot at all. So I started off house hacking, bought another unit, and then my wife and I, we got married and we bought our first home. So this was about a span of about a year, right, when I actually got that portfolio going, that small portfolio going. But after that, I had kids, right, shortly after I got married, and I went a while to tune of about 7 years, really, without buying anything else in real estate.
Gotcha. And so when did the light, was 7 years like just busy with family, or were you kind of considering your next step, or what was your
Yeah, it was really, I didn't know what else to do because I didn't have the money to put down 20% on another property. Prices were going up, right? And so I was just trying to chase the next deal and wasn't doing a very good job of finding one.
Got it. Got it. So you have the couple, you have the family going on. You're kind of short on cash. You're trying to find, can't really find the next opportunity. Um, at what point did you realize that multifamily, or what was it that said multifamily was the way to go?
Yeah, it was really the power network. So I just so happened to have a neighbor and he was doing a lot of real estate, and I was like, wow, how are you doing all this? How are you learning? And it really got me back in the game. And I was like, you know what, I need to pick it back up. And so I was just on an island doing all these things by myself, trying to figure it out. And once I got around him, right, he told me that he was learning a lot from podcasts. So I started listening to podcasts. And at one point, I really just realized, like, hey, if I want to scale this real estate business, right, I'm going to need a lot of houses. So I sat down one day and I just did the math, and I'm like, how many of these houses do I need in order to really be able to live off of them and retire myself? And then that's when the light bulb went off. I was like, whoa, this is going to take me a lot of time and I don't have the money to do this. And so that's what led me to really just start scrambling and trying to figure out other methods to be able to better myself.
Got it. Got it. So you mentioned a 34 unit. Tell me about your multifamily portfolio.
Yeah. So as I mentioned, we scaled it to a little over 1,000 units, but then we started selling some stuff in 2021 and this year as well. 34 unit was how I got started. It was a beat up property, about 50% vacant, and I just had just enough money to really get into it. So I threw everything I had at it and just figured I'd take a shot. I learned a lot from doing that, and in the end, it worked out. But it was a pretty rough period there while I was getting started.
So tell me, what year was it? You said it was 50% vacant,
Yep.
pretty beat up.
Yep.
Was your plan? What was your plan for the property? How long did you hold it? Tell me the ins and outs of that.
Right, right. So I knew enough about multifamily that I understood refinancing and sort of being able to roll your money into another deal. So that was my plan. I said it's 50% vacant. I'm going to renovate a handful of units, maybe six, 7 units. And after I do that, I'll be able to refinance, pull that money back out, and I can continue, implementing the business plan to go on to another property. That was my initial plan. What happened was, for one, I didn't verify the income on the property when I bought it, so it was a lot lower than what I expected. And the second big event that happened was that people left. And so I didn't plan for that. And so as tenants left or they skipped, suddenly my plan of renovating 6 or 7 units, now I needed to renovate 9 and 10 or 11 and 12. And I didn't have the money to do that. So that's what led me to a challenge that I really wasn't prepared for.
So how did you overcome the lack of cash and the kind of the changing situation there from what you thought it was to what it was?
Tears and praying, man.
Yeah.
It was pretty stressful. I pulled money out of my 401k. I refinanced the property just to get some more capital, whatever it was, to just renovate a few more units. I then had I want to say I refinanced that property 2 or 3 times, right? It was really just trying to put money together to make it work. So it wasn't the ideal way of doing it. Had I worked with somebody else or been more knowledgeable, I could have probably got the finance cost rolled into the initial loan, but I didn't know to do that, so I just went for it.
Got it. And in the initial loan, you said it was 50% vacant. So I'm assuming, were you in a hard money situation, or what was your
No, I
financing, original
did.
financing?
No, I did find a commercial lender that loaned me, I want to say maybe 75%, 70 or 75% of the purchase price. But I found that out the hard way. I probably went to I don't know, 10 banks or so, and just kept on getting rejected. And it wasn't until I had to understand that they were rejecting me because I didn't have a pro forma. I didn't even know what a pro forma was then. I was like, hey, I want to get a loan on this property, and I'm taking it to the bank, and they're like, no, no, no. But finally, a lender said, we don't know if this property is going to make it, for 10 years. And that's when the light bulb went. I was like, oh, you don't know my plan. You don't know that I plan on renovating these units. And so after I did that, it changed things, and I was able to finally get a banker to say yes.
Yeah, no, learning the banker language is kind of, if you don't know it, you're the outsider looking in and don't understand it. But once you do have an understanding of it, it definitely makes the conversation easier.
Hmm.
Knowing the numbers they speak and how they want to present it and stuff. I've been there, done that kind of thing. I get it. Um, all right. So you have the situation. So how many units did you renovate? You said you refinanced it multiple times. Do you still have the property?
No, no, sold it this year.
Okay. And how many units did you end up renovating before you sold it?
Just about all of them.
Okay. And how long did you have the property?
Bought that in 2016, so just sold it this year. So that's what, 6 years.
Got it. Got it. And positive exit then, I assume, based on
Yeah,
the
yeah,
length of time.
it turned around. It was the last refinance where I got all my money out, and that was the initial business plan. So I just held the property as um, cash flowing asset for the last several years, and then decided to exit out of it this year.
Got it. Well, congratulations on full cycle. I'm guessing your story now when you talk to a bank is considerably different than the first one. Uh,
Yeah.
and credibility you've got based on having bought a property, executed a plan, made it successful, and then sold it. I'm guessing gives you an entirely different, positions you entirely differently than the new guy that, like you said, doesn't know he needs a pro forma, just wants the money kind of thing. And
Hmm.
congrats on that.
Thank you.
So, all right. So you get the first property in 2016. At what point did you, or were you able to start buying additional properties, or how did you go about getting additional units? Were you doing going solo? Were you doing joint venture? Were you doing syndications? How were you able to grow your portfolio?
Yeah. So while I had that 34 unit, I was really sort of bored, right? So I was living in the Washington, D.C. area. This property was in Tennessee, and the business plan was being executed, but it didn't require a lot of my time. However, I had all my money into this deal, and I'm waiting for us to renovate units so I can get a refinance and be able to go buy more real estate. During that time, that's what led me to reach out to some other people and say, hey, I really want to do a deal, but I don't have any money right now. And so the advice I got was like, hey, Jason, if you understand apartments and you know how to operate successfully, you can raise money with other people. And so that's what led me, even though initially I never wanted to syndicate or use anybody else's money. Lifestyle, life circumstances just sort of led me to desiring that. So at that point, I knew I made mistakes in the first deal, so I went out, I got a coach, said I need to know how to raise money, and I need somebody looking over my back to make sure that I don't screw anybody else's money up, right? Making mistakes like I did on the first one.
Got it. Um, can you share who'd you work with as far as your coach?
It was Charlie Dobbins.
Okay, I've seen a lot of his posts. And what were some of the things you learned from Charlie? Uh, based on how to operate with other people's money versus what you were doing solo when you were operating on your own.
Yeah, well, I learned how to verify the income. That was one thing. So, the next deal I did, I was definitely asking for bank statements and not just trusting a rent roll or any sort of tax returns or things that I was trying to get before. Also, it gave me more than anything confidence that I was doing the right thing with the apartment complex. Like I mentioned, the mistakes I made in that first deal, that's how I realized that, hey, I there's just a lot that I don't know that you can't pick up out of books or even just some online course, right? You you really have to be detailed and professional. So having a coach that was able to look over my shoulder, here's your deal, here's how you raise the money, here's how you put together a property package, all of that just helped build confidence to go out and try to pursue another deal instead of just doing it by myself.
Got it. So you work with Charlie. How long before you're raising capital and into the next deal?
Um, let's see, that deal closed, the first deal closed late 2016, and I was um almost 2017. So it was about a year. A year later, I had the first syndication.
Got it. And how many units was that?
That was 48 units.
All right. And was it in Tennessee or
It
whereabouts?
was close. It was about an hour from the first property in Western Kentucky.
Gotcha. Uh, so you get the second unit or the second property. Uh, what's the plan for that? Is the value add? What's your strategy?
Yep, it's value add. We were looking to renovate those units and increase the rents. So that was it. It was pretty straightforward. However, with each new adventure comes new challenges and new learning.
So what were the challenges you found on this one?
Managing investors. I went from, what was it, just a 34 unit to now 34 plus 48. And I didn't have a team for that, so I found the deal. I did the due diligence. I went to the loan officer. I signed on the debt. I raised the capital. I did everything. And during that time of getting that deal closed, was probably one of the most stressful periods of my life. I don't ever want to do that again, right? But that's what I learned. And then I also learned that I struggled with raising capital. I thought that that was going to be something that would sort of take care of itself. I'm working with Charlie. There's plenty of people who want to invest, right? I was drinking the Kool-Aid a little bit that you could just go out and find investors. I didn't actually start raising capital for it or even talking to investors until not only I had the property under contract, but I finished my like 30 days of due diligence.
Oh
So
boy.
I'm like 30 days. Now I'm like, now it's time for me to go raise some money. And uh it was a challenge, right? So I was under the gun. I struggled, right? I definitely struggled with trying to make that happen. But what was born out of that was really the understanding that you need a team in order to do this and don't try to do it all by yourself. So that's what I learned from that. After we closed on it, now I'm asset managing not only the 34 unit but this 48 unit, and then I'm also working a full-time job at this time too. So it's very stressful to try to figure out how to take property management calls and underwrite asset manage and all those things. So that's what led me to start building the team. I started leveraging virtual assistants to just get some things off my plate.
Got it. So you your timeline there for raising capital was kind of short. How large was your raise for that
Half
property?
half a million.
All right. And how many investors uh did you end up putting together to get the 500,000?
That's a question I got to go back around. I'd probably say maybe 15 to 20-ish investors, probably, and that may be less. We did it in $25,000 checks, so that allowed for us to have a lot more investors than if we were doing like $50,000 or something like that.
Gotcha. But you got it done. I mean, that's the main thing that you were able to get the property. You had it under contract. You done all the due diligence. You were able to raise the capital. Were there any timeline issues where did you have to get an extension to raise the capital, or how did that all go smooth once you realized the situation you're in? Or
I don't know if anything went smooth. It was it was rough. So I initially, when I started, one of the first conversations I had was with an investor, and he said, I like the deal. I'm gonna invest, 250,000. And so I was like, whoa, this raising money thing is really easy. I only got 250 left. I had a couple of other yeses, and I felt pretty good about my ability to close. What happened after that is that the investor who was going to put in 250 eventually came down, said, I'm only going to do 100. Said, okay, that's a little bit challenging, but we can still make it work. And then that investor went to 0. All right. And this is probably about maybe call it a week, 2 weeks prior to closing. And so I was left with a big gap with not having enough money to close the deal. And so yes, I did have to exercise an extension, and that cost some money, to buy another extension. But during that time, I was really scrambling, trying to figure out, what I was going to do, how I was going to close that deal.
Got it. So the investor that committed 250 down to 100, down to 0, have they done any deals with you, or has that just been somebody you've kind of exited from your list of
Well, yeah,
investors?
it's one of the issues that come along with just raising capital and not necessarily having long lasting relationships, right? I feel like
Right.
people, you don't know each other, you try to get married very early on, and it's just one of the things that they don't know you, you don't know them. And so no, we didn't go on. I mean, it's no bad blood about it.
Right.
I'm glad that it happened in hindsight, right? But it just goes to show that you really need to start developing those relationships and nurturing those relationships early on, so that you feel better going forward, and also you want to know who you're operating with.
No, that makes complete sense. The situation there with the investor backing out, as you've gone forward, how have you corrected your approach to make certain that you're not, um, you know, held hostage there at the last moment and in a scramble position? Do you raise more than the need is? Do you get commitments beyond what you're looking for? Do you raise for capital improvements? Tell me a little bit about your strategy.
Right. We always try to have more capital than what we need in order to close. Really feel comfortable with probably call it an additional 20 to 30% and soft commitments is what we're aiming for. And then also just having more investors, right? The lesson from that was just understanding that this was just one investor that was a large chunk of the equity needed. And so there was nobody else to really swap them out with, so you want to have a larger investment pool. And what we find is some people that are going to do a lower amount end up contributing more. And then, some people who will initially do a large amount will come down a little bit. It's just the nature of the beast, right? So we try to prepare for it by making sure we have plenty of investors. And usually if we're around that 25, 30% additional capital, we sort of feel like we can get it done. In addition to that, I also work with other partners now, and we all work together on the capital raise. So it's not just me depending on my network, but it's also other investors in their network as well.
Got it. So you did the 34 on your own. You get the 48. You syndicate. You get it closed. You're executing your business plan. Um, Tell me about the next. How quickly are you going with the next properties? I mean, to get up to 1,000 sounds like you got to be doing some deals.
Yeah. So the way it happened for me was just doing larger deals. Once I actually got the partnership down, I understood partnerships, and that's how you really want to leverage. I wanted nothing else to do with just trying to do a deal on my own. So I kept networking, met other groups that were doing larger deals. And so my next acquisition was 350 units that I became a general partner in, really by just being an acquaintance. So, but what helped that is that I had some experience, right? I wasn't necessarily a newbie. I did understand business processes and all that. And so I was able to add value to that team by bringing in what I already knew, the investor database that I had, and we sort of partnered up on a larger deal like that.
No, that's awesome. So you're scaling pretty fast. You start with the 34. Within a year, you've got a 48. How long did it take you to get the 350 after the 48?
I want to say that was about 9 months after the 48 unit.
All right. So you're full in the networking and looking for the next deal and raising the capital and staying engaged with your investors. I'm assuming based on we're looking for more deals, or was that more of? And tell me about that. I guess you mentioned the challenge of managing the investors. Tell me about your communications with your investors since you bought the first property. I mean,
Yeah,
the
so
40.
it was initially we were doing quarterly distributions. I would try to send out a monthly email. And then at the end of each quarter, I tried to go back, reconcile the numbers, put together our budget, update the financials, and then send that out so that our investors could see with complete transparency how their money was being utilized. Since then, we now do monthly distributions. And so it's more of a term, but investors like it. And then I like it as an operator too, because it really makes you stay detailed on your property. How do we do this month? Where are we at? What was our CapEx budget, et cetera? So that's how the communication goes on now.
Got it. Well, it sounds like yeah, I mean, what I'm trying to say, you've clearly come a long ways from where you started. The solo guy, not knowing how to talk to a bank, to manage a team, general partner of 350 unit properties. That's quite an amazing story in a very short amount of time too. I mean, that to me is really amazing that just in less than 2 years, you're really able to scale, and my hat's off to you. That's incredible. Sounds like team was really kind of one of the key things in that. I want to ask you about the affordable housing aspect. When you say affordable housing, um, tell me how do you define affordable housing?
Yeah, I like the way you phrased it, right? How do you define it? Because it is one of those words that depending on who you're talking to, it could mean a lot of different things. So you have affordable housing, you have workforce housing, impact investing, all those terms get thrown around and sometimes interchangeable. But what we call affordable housing is housing where the tenant is only paying 30% of their income in rent. All right. And I think that's more the technical definition of what's affordable. Because the market has turned over so many times, keeping rental incomes at that level has become challenging. So you have tenants now that are paying 40%, 50% of their income going just to rent. What we're doing is working with government programs to try to keep those income levels somewhat reasonable. And so we specialize in the low income housing tax credit space. And in that space, you have government regulations, and they may say, according to the area median income, we only want people at this property to be paying, say, we only want tenants at that property that make 60% of the area median income. So it's income restricted for those people that live there. And then based off that income restriction, we don't want them paying more than 30% of that income in rent. So that's sort of how the project works.
Got it. So you are doing LIHTC, I mean, the tax credits. Um, and tell me a little bit about that. It's been a little while since I've talked to anybody about it. But if I understand right, well, you tell me, and then let me hear what you could say, and then I'll tell me how's the financing work for low income housing tax credits.
Yeah, so the challenge with all of this is that it's hard to develop projects, maintain projects, and keep rents affordable with costs that are just always rising, right? And especially if you're working with investors that want to get return on their investment, it's difficult to make that happen without having some sort of government intervention. So in the tax credit space, we're talking about public-private partnerships. And how that works is the financing will probably be 85, 75, 80%, even sometimes 90% of the debt will come through lenders. And so I probably should establish this too, that when I talk about affordable housing or tax credits. I'm doing new, not new, but existing properties, right? So it's already there. It's already been developed. We aren't doing any ground up construction yet.
Is
So
the
that's how
property
we
is the
looked at
property already in the low income housing
it's
program?
it's already in the process.
Okay.
Yeah, that's what we looked to buy.
Okay.
So we're buying a tax credit deal. We're going to get, let's call it 85% leverage from a bank. And then the way the equity works is initially we use private equity to acquire the property. Right. So it's just like a standard syndication, but it has those income restrictions on it. And so we still found out that we can operate those projects and still make nice returns for our investors. That's one aspect of it. But we also want to keep these projects for the long term. And what we do is called a resyndication. And during a resyndication, this is where the um, public-private partnership comes into play. So say we have a project and we want to stabilize it and leave it affordable for the next 15 years or so. We'll go back to the government agency and say, hey, this project was already approved as a tax credit property. We want to make some upgrades and leave it as affordable for the next 15 years. That works where you'll have an entity for the equity, and that may be like a Bank of America, Wells Fargo, Amazon, somebody like that, and they want tax credits. So the way the project works is you have your, call it 80% leverage from the bank, and then the 20% equity piece comes from that entity. And they're not necessarily looking for a return, they're more so looking for the tax credits. The good thing about this though, and the way that we found a lot of value in this space is that the government wants to stabilize those projects for the next 15 years. So and on market rate rehabs, we may do 5,000 a unit, 8,000 a unit, something like that. In the tax credit world, we're doing 30,000, $40,000 per unit renovations on these projects because we're really getting them ready to last for a long period of time. So windows, HVACs, flooring, appliances, you name it. If it's not going to last 15 years, it gets changed. And that's where I really like sharing information, because a lot of people, they hear affordable housing and they think that we're talking about the projects, the ghetto, properties that just aren't that appealing. But once we finish this level of rehab, you really can get some pristine product, even A-class product that is affordable to tenants, and that's what I like about it.
Got it. So the capital stack, when you first buy the property, you're raising capital from your investors, right?
Right. Yep.
You're getting a loan from a lender. You acquire the property basically, like you said, 80-20 ish. Is that kind of the starting point where you like a target?
Sure.
Okay.
Yep.
So you acquire the property, then you go back to, and I assume it's is it through the local housing? I'm trying to think of who you connect with to, uh, do you have to reestablish the tax credits, or are the tax credits there, and then you basically go and then seek out the larger equity uh, swap. I mean, I say swap, but you are basically selling the tax credits to that other entity that needs the tax credits for their own benefit,
Correct.
and you
Correct.
get that capital, which basically allows you to then go and uh, recapitalize the property. Am I understanding that right?
Right. So we go into these with two business plans. To answer
Okay.
your question about where do you go, each state has its own agency. And so right
Right.
now we're only focused on Tennessee and Georgia because it becomes problematic to try to learn all these various different states and who to go through and their different requirements. So we focus on those markets. We go to the state agency and we do an application. So every time we buy an apartment complex now, we really have two business plans. One business plan says we get approval from the state agency and then we'll go in and re-syndicate. The other one is we don't want to be dependent on that, right? We don't want to put our investors' capital at risk. So we also buy it with just a 5-year projection as a value add deal. And so when both of those deals check out, we say, hey, we can go in and re-syndicate it, and we can also just keep this property as a tax credit deal. Then it's a green light on that asset, and we, we pursue it. So to the investor, you're either going to have a 5-year hold period with decent returns, or you'll have a shorter term project with decent returns, right? So that's how we try to attack it.
Got it. So the initial investor, there's an exit, 5 years or less on the plan. You get the approval for the tax credits, and you re-syndicate. So I'm assuming at that point, the investors are either cashed out or they have a chance to reinvest. You can bring in other investors. Is that, is it essentially
Yeah,
like a sale, but not a sale?
right.
How's that?
So it's basically selling the project into the tax credit program, right? So
Okay.
it is a sale.
Okay.
However, it's the investors cannot stay in, and there's tax credit law around that about ownership percentages, and it gets really tricky. How it is initially, that's what I wanted to do. I wanted to keep our investors with us throughout the duration of the project, but it just can't happen. So they're exited once we sell it into the tax credit structure.
Got it. So the returns on the initial purchase makes sense. Tell me about the returns for investors when you go into the tax credit program.
Yeah, so a lot of those returns come from cash flow operations, right? So they have cash flow depreciation just like any other syndication. Upon exit, what we do is they they get a bump as we sell it into this new tax credit structure. So they'll get the cash flow through the duration of the project, call that 1 year, 2 years. And then afterwards, once we sell it in, then the investors get a return. And depending on the project, right, we determine, hey, what will our investors going to be happy with? And we try to make sure that they're very happy that they invested with us for that brief period of time. If it's basically functioning like a bridge loan.
Got it. So you put it into the or you re-syndicated. So you've got a new pool of investors. They're getting into a LIHTC, low income housing tax credit property. Um, how do those investors, how are they um, rewarded compared to the original syndication?
Yeah, so you're talking about the new larger entity that will come in and just wants the tax credits. And it's
Okay,
usually
so
not a
and
pool of
maybe yeah,
investors.
let me be clear. So when you re-syndicate it, are there any of your investors that are coming in, or is it strictly just the larger tax credit equity investors?
It's just the larger tax credit investors.
Got it, got it. So you're it's basically an exit for you. Um, but the so the do you maintain any position in it once you re-syndicate it?
Yes, yeah, we do. So still stay in as an operator, but now you're operating for a different equity group. So instead of
Okay,
our,
that's what I was trying to. I was
yeah,
getting a little bit confused there. So okay, so you do a syndication. You have a investment or investors. There's returns. They get their money, and then you re-syndicate it, and then you're the operator. And okay, I get it now. I get it. And those properties, when you do the re-syndication, those tax credits are what is scheduled for like 15 years. Is that how that?
correct. Yep.
Okay, got it, got it. And what you said that the government is really interested in stabilizing that. When you is it required that the whole property be low income housing, or are there different um, levels? Can you do like part of it be low income housing and part of it not be, or is it just based on the numbers that only works really if you just make the whole thing low income housing?
Yeah, so they'll have what you call a LURA or LURC, right? Just a land use restriction covenant. And so based off what that is, that really determines how the property is going to operate. So it may say 50% of the property is only going to be available to people at 60% of area median income or less. And then you may have the other 50% that's at 80% area median income or less, right? So, and you can break that up sometimes 30 and 60s and 80s. Sometimes you have market rate and restricted units all in one. So you can get pretty creative with how that works afterwards.
Got it. Got it. Well, that's fascinating that you went from the market rate into the low income or housing tax credits. I know I've had a little experience with different types of government financing, and what I do know is that really makes it the possibility for greater returns when your capital requirements are substantially lower. It makes it a whole lot easier to service the debt, and that's why the lower amount of income requirement from the tenant works and that. But no, that's awesome. I'm glad to hear that you were able to figure that out. And so are all of your units now? Is that the focus of your investment strategy?
Yeah, we're very much focused on the affordable space.
Got it. And that community of low income housing tax credit operators like yourself, is that a fairly small? Is there room for more? Is it basically, if I wanted to do this in another state and kind of learn uh, the government agencies and that, are they typically looking for more properties?
It's challenging. So there's a huge need for more affordable housing. However, the developer pool of people who know this information and are building units is relatively small. And even with that, it's competitive, right? So there's multiple people bidding on these projects as they come up for sale. So it's competitive, just like market rate. Um, Competition, multiple offers, hard money day one, all of that still exists. So is there room? Yes. Is it needed? Yes, but it's also challenging.
Got it. Got to know what you're getting into. That's great. Well, I'm my hats off to you for figuring it out, because like I said, I've heard about it and understand just enough to recognize how the deal works there, and understand that it works really well, especially kind of having that long-term capital commitment. And like I said, being able to look at a project with a longer view, 15 years, as opposed to let's get in, make it pretty, get out, um, and leave it for the next guy kind of thing. And I like that kind of a philosophy more of kind of the, something that's going to last. But that's just me.
Yeah,
But anyway, hey, Jason, if we could, I'd like to shift gears here for a second.
sure.
By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's a couple strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when that doesn't work, we look to see if there's a way we can transfer the risk. And as such, I like to ask my guests if they can look at their own situation. Could be clients, investors, political, interest rates, the market, however you want to define or identify what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so, if you're willing, I'd like to ask you, Jason Stubblefield, what is the biggest risk?
I would say the biggest risk for me would be doubting yourself, right? Because the foundation of the company, the foundation of the business is all based off of belief. Every time I've done this business or do another deal, there's some new challenge. And with that, it's like, how do you meet that new challenge, right? The market changes, the market shifts. Currently, we're seeing higher interest rates. And so if you lose that confidence in yourself, there's always pressure to say, let me just go to a different asset class, or I can't figure it out, or it's too competitive. But if you can just keep the belief or never risk losing the belief in yourself, I feel like that allows you the ability to adapt and overcome in any given situation.
Definitely makes a lot of sense. Got to believe in yourself. Hard to convince others to believe in you if you don't believe in yourself. So that's
Absolutely.
good. Good. Jason, where can the listeners go if they'd like to learn more or connect with you?
Yes, if you go to jasonstubblefield.com, got multiple ways to connect through that website.
Awesome. Jason, I cannot say thanks enough for taking the time to talk today. I've enjoyed it. I've learned a lot, and I look forward to doing it again soon.
Awesome. Thanks for having me. Appreciate it.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.